Good afternoon, everybody, and welcome to this edition of our Think Learning webinar series. Today, we're going to be discussing turnaround stocks, more specifically, the 4 turnaround stocks we discussed earlier on in the year. At that time, they had suffered significant falls in terms of their prices, each of them facing their own unique and substantial set of challenges. And we asked the question whether they were worth adding to your portfolio at the time. And the unanimous decision on all of them was that it was not yet time to buy them. So we're going to review those 4 stocks. We're going to plus one, add one more today. We'll see what that is in a second. Okay, what is a turnaround stock? A stock that is dealing with a significant adverse earnings shock, or in many cases, we're going to see today an enduring attack on earnings or decline on earnings. Often those shocks are extraneous to the business, so it's not necessarily something that management could have foreseen or predicted or prepared themselves for. A good example, of course, is the COVID-19 pandemic. But we can have other extraneous events. For example, Treasury Wine Estates earlier on this year had a 176% tariff slapped on all of their exports to China. We obviously see a significant decline in the share price as a result of that shock. And the question then becomes, is it still prospective for returning to growth, to returning to the glory days prior to that shock? And therefore, does it potentially represent longer-term value? Is the stock undervalued because of this event? Be careful though, because a big price fall does not necessarily equal a big price recovery. Sometimes these changes result in a permanent decrease in the company's earnings. Don't forget, markets are always looking forward. They're not looking backwards, and they're forecasting and discounting earnings into the future. So if the share is at a particular price that maybe you think is cheap, it might not be at a price that the market thinks is cheap. And if I'm going to say anything of any value today, it is that it doesn't matter what you think about the value of a particular company. It really only matters what the market thinks of that value. And hey, the big research houses, big broking houses advising their clients with the most money, they are doing research based upon what's going to happen, not what has happened. So looking at historical PEs can be very dangerous. So if you are looking at a company that might have a PE, historical PE, based upon previous year's earnings of 10 times, okay, so the price divided by the earnings. Let's say we've got a $10 share price at the moment and a $1 earnings per share, which gives us, of course, a PE of 10 times. If you're working on historical values, the problem is that the market might be working on expected values. Maybe the earnings per share is expected to halve over the next 12 months, and therefore, at the current price, the PE ratio is not actually 10, but the forward PE is actually 20 times. Maybe earnings are expected to be only a quarter of what they were, and in which case our price to earnings ratio significantly increases to 40 times. So we might have thought we were getting a real bargain here, and with a cheap PE of 10, but in actual fact what we're paying is significantly more. So we need to be careful about that. Anytime there is a higher risk, and there's always a higher risk with these turnaround plays, we've probably all been in this situation. Wow, that looks like it's down a lot. I'm going to buy it because it's going to go back up very quickly. Typically, these recoveries take many, many years, and it will require regular monitoring and reassessment of whether the turnaround that management has instigated remains on track. So it's not a quick pick and then profit. It is a considerable amount of work to do the research and then maintain the vigilance. Okay, so the ones from last time, we're obviously going to redo these today. Our quote-unquote original turnaround stocks are A2 Milk. That's down about 64% from its highs based upon yesterday's closing prices. Appen down a whopping 71% from its closing high. KOGAN.com down 55%, and Treasury Wine Estates down 39%. Certainly the first 3 are all down more than the last time we reviewed them. And just a reminder that the last time we reviewed all of these stocks, we said to avoid them, or we didn't necessarily say they were terrible, but we said it wasn't time to buy. So these are all down more, and Treasury Wine Estates is the only one that has gone up since our last assessment. It's up about 7%. So net, not buying, I think, was the right decision at this stage. And we're going to review that and see if it's time to buy those. Plus one we're going to add is probably the one I get the most inquiries on, which is AGL, and that's down 62% from the high, so it certainly qualifies in that regard. Our selection process involves a couple of main components. The first one is fundamental analysis, and we're asking two questions here. Do we have the right company, and are we paying the right price for that company? The right company for me, putting aside the nitty-gritty of what it does, is one that is in a growing industry and it has itself growing earnings. So they're the two key components for me. Is the industry growing? Is the company growing earnings? And it's tough because turnaround plays often are there because there's been a short-term impact on that earnings growth. So maybe there's a little disconnect there in terms of what we're trying to achieve, and that isn't necessarily a bad thing. We just need to understand that the stocks we are looking at aren't those necessarily at this point in time with growing earnings. So keep that in mind. Are we paying the right price? And certainly this one is more akin to what we're trying to do, because with significant falls in prices, we saw up to 71% on some of these stocks we're going to talk about today. Maybe we might be getting something cheap, and we need to do that research. Are we paying a reasonable price for hopefully some growth that's still in the business? There might be a bit of a disconnect on the first item. The second item is probably more in the ballpark of what we're trying to achieve. And some of the valuation metrics we can look at, enterprise value to revenue, price to free cash flow, price to earnings growth rate, and return on equity, all very, very important. There will be a link to the end of this video if you're watching on YouTube to a webinar I've previously done on fundamental analysis discussing all of those things. The final, and for me, personally, it's the most important aspect of our analysis, is the chart reflecting the value. So let's assume we have found something we think is fantastic value. Is the market starting to see that, and therefore demand is greater than supply and price is pushing up? So this is about timing, the timing of when to buy. Is the price in a short-term uptrend? Is the price in a long-term uptrend? Is the price near an opportune entry point? And once again, if you're not familiar with this concept of technical analysis, there will be a link at the end of the video on YouTube to a technical analysis webinar to bring you up to speed. Okay, first company today is A2 Milk. I'll spend less time on what they do because we have done this before. We've done a webinar on what they do before. In fact, I'd almost say press pause if you're watching the recording and you can have a read of that and watch to its full extent that wonderful glossy video that's playing there as well. But if you had your head in the sand over the last 12 months, infant milk formula on screen right now and fresh milk producer. Okay, the challenges that have hit A2 Milk more recently, mainly around the pandemic and the impact of pandemic on cross-border movement between China and Australia. And that has adversely affected what we and the company itself calls this Daigou sales channel. So Daigou means sales of English branded baby formula across the border into China, generally by a lot of students and tourists who would come here and purchase this formula and literally pack it into boxes and send it back home for sale over there, or via e-commerce channels as well. So the various local ones, I must admit I'm not familiar with, but for us over here, if you could imagine via an Amazon or an eBay, that would be our equivalent. It was a significant side hustle for a lot of the Chinese students that were here, and we're talking order of magnitude of about 300 million Australian dollars, about 20% of pre-COVID sales, and importantly, it was a huge growth earner for them. It was growing at about 30% prior to COVID. Most of that has been wiped out, unfortunately, now because of obvious border lockdowns, movement restrictions. The company's rhetoric has largely been that this is a temporary issue, and I've put a question mark there because my own opinion is that this is not necessarily a temporary issue. It's not going to be a 6-month, 12-month fix. We're talking potentially years until this is back up and running again, if it ever gets back up and running again, because whilst it's not running, as you can imagine, people are going to seek alternatives, and those alternatives may well become entrenched, and we may not see a return to this style of commerce. Other structural issues facing this segment of their business, and the one we're going to talk about next, which is their Chinese branded infant formula. It's just lower birth rates in general in China. And we know recently China has increased from a 2-child policy to a 3-child policy. That was earlier this year, in order to combat those low birth rates. And in the absence of potentially some of this daigou, a general switch to local Chinese branded formulas. So there has been historically a lack of confidence in the local product, but that is gradually changing, and Chinese consumers are becoming more and more comfortable with Chinese branded products. So that could be far more structural than temporary, and that is a concern for me going forward. And a nice little segue into the next slide, which is less about challenges and more about outlook. Where do we go from here? Certainly the daigou is their biggest short-term challenge that they need to address. Some of the solutions the company has proposed is to write off over $100 million worth of old stock. So we had a lot of stock really not going anywhere over the last 6 to 12 months. These products have expiry dates, and if you're talking about giving something to your child, you're not going to buy something near, it's certainly not past its expiry date. So with a lot of stock sitting around in these various channels, they've had to simply write off that stock and replace it potentially with new stock for those channels. They have increased their marketing, so that's increased costs straight up there. They are also investing in their e-commerce capability to reduce some of this reliance on that cross-border movement that's required. And the company has itself said, in their words, significantly reduced sales will continue through FY21, and we will not get a further update until next month in their results as to how they are tracking on this. And this is a quote from their 10th of May release. The trading dynamics in the China infant nutrition market have been and continue to be challenging for us. Okay, a little bit more on the outlook for the broader company. It's not just the daigou, it's far, far more than that. They are selling a Chinese branded product into China, and it was going really, really well. I mean, as in, we're talking in the first half of this year, up about 40-odd%, though moving forward from the March quarter to the last quarter of the last half, we're seeing an 18% decline. So some of that is starting to taper off as well, potentially. They are, though, increasing their store footprints. That is growing, so they're getting in more and more stores in the Chinese market, and their market share held steady. It was up to the end of the half, but was steady in Q2, Q3, so that's encouraging. But that, you would think, is longer term still going to be a large area of growth for them, but it's concerning that we did see a significant tapering off there in that March quarter. Milk sales, so fresh milk sales in Australia and the US continue to be robust and roughly in line with the expectations, so that is important as well. It is still the largest source of their revenue, and the company in the April update, I'm going to say, because it might have been the May one, did say that they're thinking of a potential share buyback, so that would indicate management feel that their shares are undervalued. They've got about $700 million of cash sitting on the balance sheet, and they may well put that to work by buying back shares. So that's potentially a vote of confidence in that management sees in the valuation at current levels. And on screen, I probably should mention some of the graphics on screen because I don't like to have lazy graphics on screen. But just going back a couple here, we have seen the significant decline in this segment here and this segment here, which is the English branded infant formula sales. But the good news for them was, and I did mention that in the last quarter that's not the case, I should say second from last quarter because we've just finished the fourth quarter, we were seeing growth in the Chinese branded formula, but significant declines in the English branded formula. Okay, moving ahead, this is just showing here that the liquid milk revenues are still robust, and that is important as well, and they were still, as of the last half, growing their market share in Australia. Okay, let's get out of the words and into the numbers, and we're looking at the broker consensus and financial data. So these are broker numbers. They're not my numbers. This data comes from Thomson Reuters. They compile various estimates from the biggest and most influential broking and research houses. And for example, we get an average earnings per share for FY22 of 22 cents per share. Okay, and the number of brokers polled, it doesn't have a whole number there, but if you add it up, 1, 2, 6, 9, and 10, there are 10 brokers that come up with that average there. Okay, so it is important data because it is telling us what the market thinks about the numbers for A2 milk going forward. In terms of what the brokers are saying, their recommendations, we do have 1 strong buy, 1 buy, 4 holds, 3 sells, 1 strong sell. It's always concerning when I see sells and strong sells. That we say beauty's in the eye of the beholder, and 4 beholders have looked at this and said, I really don't like this stock. I think you should get it out of your portfolio. The average rating is hold for whatever that's worth. The mean target price of where they think the price can get to, typically they're looking sort of 12 to 18 months out, is $6.39, and that represents a significant discount to the closing price there at $7.15. Now, of course, it might be different. That closing price might be different when you're listening to this recording, so to keep that in mind also. There is a high estimate of $10, but a low estimate of $4.60 there. Having looked at some of the numbers going forward, we can see from FY20, okay, where things were still growing. We're talking up to June 30, 2020. In that first half, even though COVID had started in that first half, we actually saw a bump in sales as almost a flight to quality and people stocking up. You remember, lines around the block to get into the supermarket were people stocking up. And I think the company kind of looked at that and said, we're going to do really well out of this crisis. And in my opinion, only maybe did not foresee some of the challenges ahead. And if you don't agree with my opinion, then let's look at I think it was no less than 4 profit downgrades after June 30, where I think management started to catch up to just how much of an impact COVID was going to have on them. And if we look into 2021, so broker estimates, we're going from 48 cents a share down to just 12 cents a share. I mean, that is a massive, massive hit to their bottom line. Still a profit though, and that's encouraging, and then looking to grow to 22 cents a share and then 28 cents a share a little bit further down the track there in FY23. I'll let you again press pause and have a look at some of the other metrics, just pointing out some of these important ones. You can, again, click on that a link at the end of this presentation to the fundamental analysis webinar. Some of these metrics here, that's pretty average within the All Ordinaries Index. The P ratio, I believe, was, well, it wasn't actually that bad, but obviously going to be very, very high going forward because of the decrease in earnings and not a commensurate, therefore, decrease in price. Growth rate is shot to pieces. I guess certainly this year, and we don't have data for those 2 years. Dividend yield, not expecting the dividend to come back to FY23, so that's important for income investors. Price to free cash flow is actually pretty good, to be fair, and return on equity has been excellent because it's a fairly low capital intensity business. Look, overall, the biggest issue for me is I think what we're paying and the lack of growth, and we will discuss that a little bit more when we get to my rating for this one. I'm going with avoid, high risk, so in the spectrum of buy, hold or sell. I don't, look, if you had it, I can't see a great reason to hold it. Certainly if you didn't have it, I don't think I'd be rushing out buying it. The risk rating is based upon what I think is the execution risk between now and the next 2 to 3 financial years. I think there's a high risk associated with achieving those earnings, and we've talked about some of the reasons why. What we're left with, I think, is a company that is priced for growth, but without the growth. And the company is assuming that many of its challenges are temporary. I would suggest they're more likely to be structural and could be significantly so. Based upon my valuation, I think the company remains unattractive, and with high execution risk, I question why you would be looking to allocate capital towards it just right now. So if we're looking at its FY22 to FY23, I've got it at trading at 23 times average earnings over that period. I'm using a growth rate of 10%, which is significantly less than the consensus growth rate of closer to 30%. We saw some of those numbers going back up. I'm just not sure if some of those brokers have some downgrades in the system, and we're certainly going to get an update in August, and that'll be the catalyst potentially for a few more downgrades. So I'm a little bit more bearish than the consensus. I've explained why. Based upon my valuation for the company, I think we're at fair value around about $6.33. So that's about 11.5% downside from here. I don't think it becomes good value until about 26% cheaper, and it's certainly not going to be a bargain until it's about half of the current price. Okay, now things that could change is this growth rate here potentially, and I'm waiting to be convinced in their August update. Certainly if I start to update this, then some of these numbers will increase, but I would suggest it's a long way between here and representing good value even so. Okay, next company we're going to look at today is Appen. It's a technology company focused on artificial intelligence, or augmented and assisted intelligence is probably another way to put it, because what we're doing here is we're teaching machines to learn. Yes, the end goal is artificial intelligence, where machines can make their own decisions, as scary as that sounds, but we're at an earlier step where we are assisting those machines in doing that via a human interaction. So on screen you can see a little bit of a video playing there, which is quite literally what happens with an Appen contractor. Typically they're not employees, they've got about 1 million contractors all over the world, and they'll be assigned a project or a task, or a set of tasks for a day, where they will literally be given an image like the one we see. And it's an image that should be very familiar to us. Cars on a road, we've got pedestrians, we've got street signs, and the application here, I would suggest, is going to be autonomous vehicles, where a vehicle using a camera can identify these shapes as being a car, as being a person, as being a stop sign, and therefore that vehicle making the appropriate decisions. It's very important we identify the difference between a tram, for example, and not a tram. So the user goes in and literally outlines what might be a car, and they hit enter, and then through many thousands of images and processes like this, we're teaching the computer to learn what is what and what is not. And if we think about just how important this process is and how important it's going to be, and the growth in this area, I'm really excited by what this company does and where it could go. It's not just image recognition, they're doing voice recognition. So if you've ever said, "Hey Siri," or "Hey Alexa," or "Hey Google," or whoever it is that you're saying hey to on your phone, or you walk into your house and your device and tell it to turn the lights on, that is also assisted by artificial intelligence. And the Appen does have some significant contracts out there with the likes of the Apples, the Googles, the Microsofts of the world. They service 8 of the top 10 companies in the world, and technology used in almost every aspect of our modern day lives, and where our modern day lives are going to be over the next generation, I would suggest as well. So is this company in the right space? I think absolutely yes. Is it the right company itself? Are its earnings growing? Well, even though it has had a tough time of late due to COVID, its earnings are still growing. We can still see revenues up about 12%, underlying EBITDA still up 8%. Now, these growth rates are down significantly from where they were pre-COVID. Pre-COVID, they were growing sort of 40, 50% per annum, and that's why we've seen a significant drop in their share price. Why has it happened? Well, according to the company, they're saying that customers are deferring, reprioritising projects due to the pandemic. There is, in general, reduced spending on advertising, and they are restricted in their ability to go out and meet and service existing clients and get new clients as well. Look, more broadly speaking, these are probably more structural issues than temporary issues, increasing competition in the space. However, Appen is very much a first mover in this space and has that critical mass of contractors, and really to start a business like this tomorrow, it would be very, very, very difficult. They have a significant moat, I believe, around their business. Having said that, the style that they're doing it, we may well wake up tomorrow and find that somebody has invented a completely different way and a better way of doing it. And that is a risk in this business as well, because technology never stands still. Appen has a great way of doing it now, but who is to say what the great way is going to be tomorrow and the next day? Okay, so that is an interesting possibility. I don't know. That is an interesting risk for them going forward. They have been unable at this stage to transition into more of a software as a service model. It's still very much project-based, contract-based, and we'll see a little bit more on that in a second. In fact, on this slide here. So they are the challenges. In terms of the outlook, the good news is it's a rapidly growing market. the total addressable market is massive, and it is growing in sort of high teens percentages every year. Okay, this is the future, it's not the past. The strong growth in relevance, the outlining of those images and similar sort of applications is going to continue, and there's a significant moat around that. Their Chinese growth is in early stages, so they're just breaking into the Chinese market, and we can see some numbers here on their Chinese revenues. Small overall at the moment, but growing nicely. In the fourth quarter, we have seen the big problem for them has been this COVID impact, but we did see in the final quarter of last year a big tick back up. So maybe things are starting to be alleviated there. And importantly, the sort of long-term commitments as a proportion of their revenue is significantly increasing. So this is moving more towards that software as a service model rather than that project-based model. So this is all good stuff that's happening. The company itself has forecast EBITDA growth of between 18 and 20% for full year 21, and that is a very nice growth multiple indeed going forward. Having a look at some of the numbers here from broker consensus, we do have an average of a buy that's encouraging. We do have 3 strong buys, 3 buys, 5 holds, just the 1 sell. That's not too bad. A mean target there of 17.60, which provides significant upside from the current share price. In terms of just looking at earnings per share through here, we can see that we are having only a fairly modest impact as a result of COVID. Compare that to the 75% decline in earnings that we saw on A2 Milk, and then we are expecting to bounce back fairly strongly post-COVID. We are obviously paying dividends. That's encouraging as well, and they are expected to grow. In terms of some of these key multiples down here, that is very attractive for me. It's much better than the market. Typically, we would say that was high by market standards. 15 is kind of fair value, 20 starting to get expensive. The ASX 200 PE, by the way, forward PE, 1 year forward PE is about 17, so it's more than that. But we're not getting the sorts of growth in the market that we're getting here. So for a growth stock, a PE of 20 is actually very, very attractive. Okay, for growth stocks, paying 30, 40 times, depending on what that growth is not unusual. And the stock was trading on a 40 to 50 times earnings multiple pre-crisis. So if it got back there, then there's significant potential upside in the share price. So that's still a big tick for me. Big tick here. Price to cash flow is very good. Return on equity is excellent, and I'd almost go an A sort of report card on the fundamentals there. Having a look at my valuation, you can see at least we've got some greens in terms of where we were compared to A2 Milk. I think it's good value up to about $13.98, which means that we're about 11.8% below that on the current price. I wouldn't necessarily say we're at great value, probably a little bit more than great value, and we're not exactly at bargain basement prices. But not to say we weren't there around the lows. Where's the value in looking at a table like this? If you're not a chartist, if you're simply looking to buy based upon valuation, who knows when the next dip might come. And all things being equal, you can use this table as a guide to judge whether you might want to buy or otherwise, based upon if there is a dip in the market for whatever reason. So if you woke up tomorrow and Appen shares were trading around $8.39, I would suggest that you are getting a significant bargain. Right now, I think there's still plenty of value in the price here. So my rating, unfortunately, is still a void. Everything I've said up to this point is a go on Appen, but the chart says wait. So I think it is the right stock, and I think it is largely at the right price. I'd love to get it a little bit cheaper. So therefore, based upon that, it is a true turnaround play. I do think many of the issues they're facing are more likely to be temporary than structural, and that is the key for a turnaround play. Management, they have barely put a foot wrong. They've done a fantastic job. So very high confidence in management. I'd almost go low execution risk on this, if not for the fact that we still have this COVID thing hanging overhead. So moderate execution risk, not low, but otherwise the valuation is very attractive. But unfortunately, the chart says wait. We're going to check out that chart at the end of the presentation. We'll check out all the charts at the end of the preso. Okay, moving to the third company now. We've got KOGAN.com. It is an online retailer, again, a very well-known business here. Had a fantastic run during COVID as we changed habits from being able to go down to the local Harvey Norman, which is obviously a major competitor, or JB Hi-Fi, and purchase our big screen TV. We had to order it through KOGAN.com, and of course many people did run out and purchase a bunch of home entertainment stuff because we were stuck, indoors, and therefore more time watching Netflix and Stan and whatever we're watching these days. So, look, they did very, very well, but as we're going to see in the next slide, a little bit of a victim of their own success. I'll let you press pause to learn what they do, and I think most of us do know what they do. So, unfortunately, they got a little bit excited, invested heavily in inventory, and probably drew, we've got two dots on a chart of sales during COVID. The one in the bottom left and the next one in the top right, and we've drawn a line between them, and then we've dashed the dashed line that goes past them kept going in that direction, and therefore management said, okay, look at that dashed line, we better order a whole heap of inventory because sales are going through the roof. It turns out that things, I wouldn't say weren't as bad as we expected, but certainly many spending habits went back to normal. Hey, we went back out in the stores, we went to many of their competitors and spent our money there. And also, potentially, we had filled our house with all of these new gadgets and therefore had less need of them going forward. So they got caught with a bunch of inventory, a little bit of a mea culpa there. Management has come out and said, look, we have not made a very good decision. I was going to use different language there, but let's go with not made a very good decision, and we're having to severely discount a lot of this inventory to clear it. They're also facing tough comparisons going forward, where we might have, and we said at the start that we'd like to find companies that are growing their earnings. If you've had a very, very good last 12 months, it's hard to repeat that going forward, and you might still have a great 12 months, but if you're comparing to a huge earnings spike, we're probably looking at negative earnings for at least a period of time until things level out again, and then we're seeing earnings growth down the track. We are facing potentially a return to normal spending patterns where we back off on some of our online spending. They are facing significant supply chain inflation. That's probably temporary, but it does impact margins quite negatively in the short term, unless they can pass those cost increases onto consumers. But this is a massively competitive space, and that's very hard to do. So that does potentially impact their bottom line. And of course, there is so much competition in this space. So the graphics on screen, again, I don't like lazy graphics. I want them to mean something. This is from their first half results. So what I'm trying to show here is the EBITDA, adjusted EBITDA, because they did make a major acquisition of Mighty Ape previously. So adjusted EBITDA was 51.7 for the 6 months ending December 31. And then we had an April update where we are seeing, so this is, this is what we should be aiming for in the second half of financial year 2021, so to the end of June 30. And if you can imagine, half of that for a quarter, okay? So we should be thinking about 25, 26, maybe 27 even, in terms of EBITDA for a quarter. And in April, we got the March quarter results and we got 7.2, okay? And that's why we saw some big drops in the share price in KOGAN since our last update, because even analysts like me who were thinking, okay, things are going very well, the company has very much surprised the market and said, hey, we are not going anywhere near as well as you were thinking, or we might even have been sort of letting on based upon our half-year results. So from here to here, and this is only a period of really a couple of months, things had changed significantly. And then we get to May, which is just 1 month after this, where now the full year range that they're giving us is 58 to 63. So compare that to the fact we've already got 52 locked up in the bank, and we've potentially had 7.2 to add on to this, and yet we're only going to be at 58 to 63. So what does that tell you about Q4? It tells you that Q4 is in the toilet, unfortunately. And what does this mean? This means the market massively downgrading its expectations for growth going forward. The outlook is all about this. Is it a short-term hiccup or a long-term structural problem? They've got lots of great things going on. They've got plenty of customers now as a result of COVID. I think that's a positive going forward. And they have made significant investments in making them a very, very streamlined player. in this industry. The other thing here is all the bits and pieces that they've got going. There's many strings to the KOGAN bow, and how many of them have achieved greater than a 1% market share, and we can see only very few have. So they're in lots of areas. They're now very experienced and very good at what they do, and we can see some of the sizes of the markets here. So I think, look, it's very exciting. It's a very exciting company going forward. And I think the long-term prospects are very, very good. But we do have not an insignificant short-term hiccup here that we need to get through. And the problem with that, as I said, is we see a major adjustment in growth rates. We see a sell in the spreadsheet, my spreadsheet as well, and many of these large brokers, where we have this number for earnings growth going forward, okay, sort of a perpetual earnings growth rate. And when we adjust that down, it has significant impacts on our valuations. So KOGAN was priced for growth. You know, we were expecting 20 to 30% growth rates. We're going to have to, even if we bring that down to 15%, we're seeing massive impacts on the valuation going forward. And I think that's part of the problem. So if we just quickly have a look at the numbers here and the broker consensus, we've got one strong buy, one buy, three holds, no sells, no strong sells. That's important. I like it when I don't see any sells. We've got an average price target of $12.46, which is providing a little bit of upside from the current $11.29. We can see here we had fantastic, massive, consistent, wonderful growth in earnings, and look, it's still expected to continue. I wonder if maybe there are some downgrades to those, maybe not in the not too distant future. But looking on the numbers that we do have, these are the current numbers, and I have to use them, therefore. Enterprise value to revenue is excellent. PE is high, but not too high if we are growing at these rates. I just have to question whether we're going to be able to continue to do that. The PEG is very good at 0.9 for FY23, not as good for some of these other ones. Dividend yield is not insignificant, that's quite good. Price to free cash flow is excellent, and return on equity is amazing there at 51%. I mean, it's almost be top 2% in the market. So look, it's pretty strong. In fact, I can't do that. I'll certainly go a very solid B. It's just this earnings growth rate. That's the bit I have the question with. So the consensus growth rate at the moment for the next couple of FYs is 24%. I'm going to be a little bit more conservative, and again, beauty's in the eye of the beholder, isn't it? So if you're the more conservative type, you probably gravitate more towards this valuation. Otherwise, if you're more believing that the market's fair in its assumption that we're going to still see 20+% growth rates down the track, then you might think that some of these need to change as well. So there is potentially more value than what I'm seeing right now. Okay, look, I've gone with avoid. I don't think it's time to buy KOGAN yet based upon the fundamentals. I think there is moderate risk. I asked me a little while ago, I might have said a very low execution risk. Now I've upgraded that to moderate risk given what's going on, because I'm disappointed by this development. I'm disappointed that management didn't do this better. But hey, look, difficult times, COVID, unprecedented, etc., etc. Maybe a victim of their own success, maybe a bit of a stuff up as well. I'm going with temporary issues, net for now, but significantly downgraded growth rate going forward. And that has changed this from potentially being quite attractively valued to not that great value right now. So the valuation is hardly attractive around the current price. With moderate execution risk, FY results may see me bump up my growth rate expectations and therefore support the valuation more. But in the meantime, I'm going to say we're around sort of fair value at the moment, somewhere between sort of, good and fair value, but it's certainly not bargain price at this stage. The fourth stock today, I'm looking at my time, I'm way over, apologies, I'm going to whiz through this one and the next one. But Treasury Wine Estates, the name kind of says what they do, so I think we can leave it there. What I will say on this slide, because I don't like lazy images on slides, is that they have restructured their business into these three main areas. This is our luxury brands here, which is pretty much Penfolds, our premium brands, and then our American brands. They are trying more generally to push themselves up the cost slash value, I guess, if that's one way to look at with wine, ladder, and it's called premiumisation. It's not a word, but it's certainly the word that Treasury Wine Estates is using to position themselves as more of a premium wine producer. The challenge has been in the news, so I will table it here and then move on, because we have had a massive tariff applied, and therefore their Chinese wine sales, which were $500 million a year prior to that, are basically going to be very, very little. Now, certainly some consumers in China, you're going to have the very wealthy that are going to say, hey, my Penfolds is twice as expensive. I don't care. I'm still going to buy it. But they're in the significant minority there. So we won't lose all those sales, but we will lose order of magnitude, 90+% of it. And that means we've lost straight up $161 million of EBITDA from the bottom line. The other problem is, obviously it was a very high margin business in China in particular. And without that business now, the average margins therefore decline significantly. What are they doing to try and solve this problem? This is probably the biggest one here. So if you're going to lose, I'm just going to go back a slide, $161 million in EBITDA straight up, let's try and save some money. So we're going to, just under half of that we're going to try and find in cost savings, and the other half we need to reposition our sales obviously somewhere else. So we're looking to go outside of China in Asia, obviously Australia, Europe and the Middle East and USA. Tweak our country of origin pipelines. That's an interesting one. So the Chinese tariffs are on Australian wine, Australian produced wine and grown wine heading into China, but there's no tariffs on wine from France or the USA. So Treasury Wine Estates does have access to, vintages in other geographic areas, and they can therefore produce wine from those areas and still get those into China. So that is another way to kind of get around it. We've talked about this concept here of premiumisation. Cost sales, they have restructured, obviously, as I've talked about, and divested a significant number of non-core brands as well, really streamlining their operations. And they've also got Snoop Dogg as well. So they're looking to, I guess, pivot towards younger consumers as well, and, looking to the next generation of consumers. And we've got Snoop Dogg's spruiking 19 Crimes over there, which is one of their key US brands. We're looking at least 2 to 3 years to come back from that Chinese impact. Numbers. Brokers saying hold at the moment. We've got 3 strong buys. That's encouraging. 2 buys, 7 holds, so mainly in the middle, but we do have 2 sells and 1 strong sell. We've got an average price target of about $11.50, which is actually below the current trading price of $11.90. Looking at some of the impact on the earnings here, so we're looking at the earnings per share line, fairly modest, because we are thinking that via those cost savings and repositioning of our sales to other geographic areas, we should actually see a fairly modest impact here from FY20 to FY21, and then the growth to come back into the business from there. It's looking at some of the numbers, not particularly great here. I'd call that an average. They are, I think, an expensive stock. I think with a PE next year of 26, a PE this year of nearly 29, and a PE in FY23, even though we are seeing growing earnings, I think it's too high, and that's evidenced here by this very high PEG. So we want to see that below 1. It's not. So we're not seeing enough growth to justify the high PE at this point in time. Dividend yield is only modest. Price to free cash flow is actually quite good. Return on equity is below market average. It would be a C, or if I'm very generous, a C plus there. On a fundamentals report card. Having a look at the valuation, I can't really make a case for this one, no pun intended, on the valuation front. And I think the execution risk is too high. There are many things that can go wrong between here and getting back all of those lost sales. It looks like the market is pricing in some merger and acquisition premium. And I have read broker research that has said our valuation is $8.60, but we are factoring a 15% M&A upside, okay? And therefore the price target becomes whatever it is, $9.60 or $10 or whatever it is. So I think that is in the market. I think that's borne out here by, because I'm not applying any M&A premium, by the fact that based upon my valuation, and I've gone market consensus growth rate here to be fair, so I still think it's overvalued by order of magnitude, somewhere between 10 and 20% at current prices. So for me, on the basis of the fundamentals, I'm an avoid, and I think there's high risk. So better risk reward elsewhere, I think, is the message there. AGL Energy is our final stock today. They generate and supply electricity, gas, and increasingly so solar for the Australian market. In terms of their challenges, many of the company's pricing structures are fixed by the governments, by state and federal governments, and in terms of their allowed increases per annum, they are often linked to CPI, for example. So we've got fairly fixed pricing, but we have significantly increasing costs. It costs a lot of money to produce electricity and to distribute it. So we are seeing significantly crimped margins, and therefore we are seeing declining profits over time. And you'll be quite shocked when you see how much the brokers are expecting profits for this company to diminish. And then we've also got this problem that they have certainly been growing their renewable energy portfolio, and that's wonderful, but they're still largely dependent on non-renewable sources like coal. The outlook here, there's kind of no point discussing an outlook because of the demerger that's in the system. If you haven't heard about it, certainly you can go Google it. I'll let you press pause on here for the finer details, but in a nutshell, given our limit on time, we're going to separate into two companies, one with the, I'll call it browner assets, the old school power, carbon-based sources of energy, and then the newer, greener sources of energy there, including our solar mainly, but I'm guessing there's probably some wind in there and hydro and a few other things as well. So we're going to end up with two businesses. In terms of the proportional splits, again, press pause and have a closer look. Let's get to the broker consensus and numbers. Brokers are at a hold, and we are seeing a stark difference here between this one and some of the other ones we've seen today. We don't have a single strong buy or a single buy at this stage. We've got 4 sells as well. So when we say hold, it's leaning towards a sell there. The mean broker price target is $8.76, which actually, interestingly, does provide a little bit of upside from the current price. But the most interesting and the most concerning thing for AGL shareholders is this line here, which is their earnings per share, which is expected to continue to fall. And it has fallen substantially over the last few years, and it's going to continue to fall substantially going forward. So that's not very encouraging. Looking at some of the numbers, I mean, this is very low, to be fair. So it's not expensive in terms of its enterprise value to revenue. Its price to earnings ratio currently at 9 doesn't look too bad, but here's the value trap. Here's that value trap we talked about at the start of this presentation. That PE is not going down, it's going up. It's going up to 14 next financial year. It's going up to 17 the year after. Earnings growth is shot. The dividend yield is going to decrease. That's a worry. And, we have to go F on here. Return on equity is about a quarter of the markets, of the average market there. So I'm going to go F on that one. And no surprise, therefore, I'm at a void with a high risk rating. I can't make a case for this on the valuation front, and the execution risk is too high. The demerger makes sense, and the greener assets will be in greater demand, but still, there is better risk reward elsewhere. And based upon my growth rate, I've gone a little bit less than the consensus. The consensus is a 25% decline in profits over the next couple of FYs. I think it's still overvalued, and here it is having fallen. I think it was 4% or 69% of whatever it was we said at the start of the presentation, and I still think there's more potential downside here, so it's a pass for me on AGL Energy. Okay, before we wrap up, we're going to go to the charts, and I'll pull this over here, and I've got the 4 stocks queued up and ready to go. In terms of the trends, we can see that we actually have moved into a short-term uptrend on the chart on A2 milk. Which is encouraging. It's encouraging if you've got it and you've been a long-suffering shareholder. For me, though, I can't get too excited until we have had some interaction with this long-term downtrend. So typically how stocks turn around, and we're talking about turnaround stocks, is that we will see a move into this long-term downtrend, and we'll often see an interaction with it. So we'll see potentially a pause in price. We could even see price rebound down beneath that, and this is some of this reason behind this high risk, I think, is associated with the stock. At the very least, if it was to go back up, we would need to see it move back above that long-term downtrend, test it, and then start to move back up again before we got too excited. So given that would take probably months to play out, there's not a lot I can do with it here from a technical perspective, but to say with the long-term trend well ensconced to the downside, I have to be and avoid at this point in time. I don't think we're seeing enough in it to suggest that the market is moving back into this en masse. Having said that, we are seeing encouraging signs that we have made a meaningful low here, but I think it's still early days. Going to Appen, we can see here that some of those profit downgrades, that one in April we talked about, it hasn't really rallied all that much compared to A2 milk, for example, and therefore the short-term trend is still down. The long-term trend is still down. There is not a lot in the volume, I think, to suggest that we have made a long-term low as well. So that is discouraging also. So whilst Appen looks the most attractive on the valuation front, it certainly is not looking attractive on the chart front. I would need to see it move back above this level here, and that high is 1467 before I got too excited. And until then, I'm an avoid. KOGAN is actually looking slightly more constructive. This is an interesting low point here, made on some significant volume and volatility and some nice candles. So that's impressive. It has traded well since then, enough to get itself back into a short-term uptrend, but more recently, more of a neutral trend from here. We are seeing first signs of an interaction with that long-term downtrend. I think that's encouraging as well. We talked on that A2 milk example of how these things tend to play out. Sometimes we come back down, we don't get through. Other times we might get through, we might have a little bit of a test of it before we break through. And it's really at this point here, in terms of a turnaround play, that I'm starting to get excited and starting to get interested. So on that basis, it is still a pass for me on KOGAN. And on Treasury Wine Estates, interestingly, as little value as I'm seeing in the share price, this one has done probably the best of all of them so far, modestly higher from the last time we looked at it. It is actually in a long-term uptrend now, as evidenced by these moving averages turning up. The short-term uptrend is fairly sound, but not all that exciting. You can see it flattening out more recently. If I was purely a technical trader, this is the one I'd be gravitating towards the most, but I'm hardly seeing any strong reasons to buy at this stage, given the lack of strength in that short-term trend. Certainly, if it was to move above that high there at 1240, it would certainly look significantly more interesting, but with significant resistance expected around that $13 mark, there's hardly a lot of upside there as well. So it's a little bit ho-hum, unfortunately, for Treasury Wine Estates, even on the technicals, and therefore it is also a pass for me. And the final one today, which is our plus one, is AGL. And I think we can see very quickly by the horrendous trend on this one, the complete lack of a switch to white candles. Look how many black candles there are on the screen. I think I could run a formula on this, but if I counted the black candles as a percentage of total candles, I reckon we're running at about 80 to 90% black candles. What does it mean? Let's have a look at this. This is what that means. This is the importance of having white candles on your chart. So we look at over the same time frame. The Australian market has gone from 4,600 to 7,200, and yet AGL has gone down. So we've had lots of up days. Okay, there's AGL. We've had lots of up days on the broader market. Lots of enthusiasm. The market opens up, and AGL. Hey, if you're an AGL shareholder, you know this. Maybe it opens up a couple of cents. Maybe it opens flat. But by the end of the day, it's beaten back down again. The market's up 30 points, 40 points, 100 points, and AGL is yet again down on the day. And what does that tell you? It tells you that ding, 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 the market's opened, and all the funds want to do is sell AGL. A good day, a neutral day, a bad day, they just want to sell this thing. And until we see a bunch of those white candles come in, I can't see any reason why you would want to buy it either. This one's probably the furthest away from being a buy purely on the technicals. But as we say, we should be trying to put the technicals and the fundamentals together. Make sure you stay tuned for another few seconds, because those links should be popping up somewhere on the screen very soon to get you to the fundamental analysis webinar and the technical analysis webinar. Of course, head to the webinar section of the website and register for some of our other webinars if you enjoyed this one. Hey, also, if you enjoyed this webinar today, make sure you hit the like button if you're watching us on YouTube, and hit the subscribe to stay up to date on our latest research releases. It has been a pleasure chatting with you today. Hopefully you got lots out of it. All the best for your trading. Till we catch up again. Bye-bye for now.